Welcome everyone, and thank you for coming and joining this webinar today. My name is Beth Lynch, and I'm here to talk about savvy Social Security and basic roles in claiming strategies. Today we're going to go over and focus on just the basic roles and strategies and things that you just need to find out for yourself. Because Social Security planning is such an individualized matter, you may have questions about your personal situation. I'd be happy to answer as many questions as possible. We're going to hold those to the end, or if you have questions during, if you want to put them in the question section, and I can answer them as we go along. But I'm sure that this presentation will answer quite a bit of those questions. Also, if you'd like to meet with me personally or have a discussion in private, we can get that scheduled. So in the meantime, I hope to acquaint you with some of the basic rules and strategies for Social Security planning and claiming, and we're going to get started. So we're going to go over 6 basic rules today, and the first and most important thing to understand is about your monthly benefits. And these monthly benefits will rise with your claiming age. In other words, the longer you wait to file for Social Security, the higher your benefit will be. To illustrate this, we need to cover a little bit of a background. We'll start with some definitions. The PIA, or the primary insurance amount, is your base monthly benefit, and it's calculated at age 62 based on your highest 35 years of earning. It's the amount you'll receive if you file for Social Security at your full retirement age, which I'll talk about next. During this presentation, we will not talk about how the PIA is calculated. It's a very strenuous and very detailed calculation, but it's important to know and understand that it's based on your earnings history. And if you've earned Social Security maximum every year for 35 years, you would qualify for the maximum PIA, which is $3,142 a month for those turning 62 in the year 2020. If you worked less than 35 years, or if you had several years of low earnings, you may still have an opportunity to increase your Social Security benefit by working longer and earning more. But our focus here is on claiming age, so let's keep on moving. Another definition that we all need to make sure we understand is what FRA is, so the full retirement age. This is not necessarily the age you plan to retire. However, it is the age in which you can claim full unreduced Social Security benefits. This used to be age 65 for everyone. Now a higher age has been phased in as a result of the 1983 amendments. For everyone born between 1943 and 1954, your full retirement age is 66. For everyone born in 1960 and later, full retirement age is 67. And those of you born in 1955 through 1959, full retirement age is 66 plus some number of months. So you might want to take a second here to make a mental note of your full retirement age based on your year of birth. As I mentioned, full retirement age is the age which you may claim full, unreduced Social Security benefits. On an earlier slide, we saw that maximum earners who turned 62 in 2020 will have a PIA of $3,142. This is the amount you will receive if you file for Social Security at your full retirement age. Even though it's calculated at 62, it's based on claiming at full retirement age. So claiming Social Security before retirement age, full retirement age, will cause your benefit to be reduced. Your benefit would then be less than your PIA, which we talked about earlier, your primary insurance amount. This is called the actuarial reduction. Conversely, claiming Social Security after full retirement age will cause your benefit to be higher than your PIA because you'll be getting what's called delayed retirement credits. The important thing to understand about reductions in credits is that they all have been carefully worked out by Social Security actuaries so that the effect upon the system is the same, whether people file at 62 or 70 or any age in between, Social Security is dealing with a whole population of people, and they know that some are going to die earlier and others will live a really long time. On balance, it doesn't matter to them when people file or how much of the reduction or credit they're going to get. But it's important to any one individual because the age you file determines your permanent monthly benefit. So if you live longer than average, or if there's even a chance you might live longer than average, you will be better off filing later and collecting a higher benefit for life, even if it means waiting a few more years for that check to start. So let's talk a little bit more about this. Now remember that I said that your primary insurance amount, or PIA, is the benefit you'll receive at full retirement age. So what happens if you apply for Social Security before full retirement age? Well, your benefit will be reduced. You will receive a percentage of that PIA depending on when you apply. So if your full retirement age is 66 and you apply at age 62, you will receive 75% of your PIA. At 63, 80%, and so on. If your full retirement age is 67 and you apply at age 62, you'll receive 70% of your PIA. These amounts are actually prorated monthly, so you can apply anytime after the age of 62 and your benefit will be reduced by the appropriate amount. If you apply for Social Security after full retirement age, you will earn delayed credits of 8% for each year you delay. So if your full retirement age is 66 and you apply at 67, your benefit will be 108% of your PIA. At 68, your benefit will be 116%, and so on. After age 70, you can't earn any additional delayed credits, so it doesn't pay to wait until after 70 to apply for Social Security. Now, I mentioned that the age at which you claim Social Security determines your permanent monthly benefit. However, in any year, there's inflation, and your benefit will get a cost of living adjustment, or a COLA. The 2020 cost of living adjustment was 1.6%, but historically, COLAs have varied widely, and the Social Security Administration projected COLAs over their 75-year time horizon to be an average of 2.6%. Now, the COLA is applied to the benefit amount. The higher the benefit, the higher the COLA will be, and applies to benefits you haven't claimed yet. So once your PIA is calculated at 62, it will rise each year with a cost of living adjustment, even if you delay claiming to age 70. So the upshot is that between delayed credits and cost of living adjustments, the advantage to delay claiming is greater than most people realize. The when to apply question is very complex and really requires a customized analysis. But here's a few points to remember. If you apply early, your benefits start out at some fraction of your PIA, the 75% or 80% that we talked about earlier on the chart, and remain at that percentage for the rest of your life. It doesn't go up to 100% when you reach full retirement age. The COLAs magnify the impact of early or delayed claiming because the annual cost of living adjustment is applied to either the lower or the higher amount. This causes the disparity to increase with each passing year. The when to apply question impacts survivor benefits as well. If the higher earning spouse maximizes his or her benefit by delaying to age 70, this higher benefit will transfer over to the lower earning spouse at death. And we will cover survivor benefits in a little bit. And of course, you will need to take into account your health status, life expectancy, income needs, and overall retirement plan when deciding when to claim Social Security benefits. So here are 3 ways you can estimate your Social Security benefit. 1, you can refer to your annual Social Security statement. These are now available online at www.socialsecurity.gov/my account. You'll need to set up an account by answering a number of security questions. Or two, you can use the retirement estimator on the Social Security website, which I have noted there on the slide. This calculator taps into your specific earnings after you enter your personal identifying information, which will include your date of birth, your Social Security number, and your mother's maiden name. And don't worry that the site is secure, so feel free to go in and try to do the calculations. Please note, though, that the annual statement and the retirement estimators do not calculate or factor in COLAs into your age 70 benefit. So this means that your actual benefit will likely be higher than they indicate on those sites. But the calculators that we use do adjust for COLA. So if you know your PIA, we can help you project your future benefits. You also may want to try some of the other calculators that are on the Social Security website. So feel free to browse around the site and play with some of the calculators, or give me a call and let me know if you have questions, and we can run an individual scenario, which I'll show you some of the examples of what that report looks like in a little bit. So basic rule number 2. Your spouse may be able to get a benefit based on your earnings record. Before we discuss the spousal rules, I'd like to make a few quick clarifications. So back in 1939, spousal benefits were originally created to give non-working wives a small benefit based on their husband's work record. But Social Security is a gender-neutral program. So husbands may be able to claim spousal benefits also. And now that there are same-sex marriage and it is legal in all states, either spouse, regardless of gender, may be able to claim a spousal benefit. More important in this age of 2 income families is that spousal benefits may be paid even if both spouses work. So here are the rules for spousal benefits. The spousal benefit equals 50% of the worker's PIA if the spouse applies for it at full retirement age. The primary worker must have filed for the benefits. That's just the rule. So in order for Jill to claim a spousal benefit based on Jack's work record, Jack must have filed for his own Social Security benefit. This rule comes into play when we talk about claiming strategies, and it can really trip you up if you're not careful. A spouse must be at least 62 to file for a spousal benefits. Again, just another rule. And if the spouse claims the spousal benefit at 62, the benefit will be reduced, as we'll see here in a moment. Spousal benefits do not earn delayed credits after age 66. The most a spouse can ever get is 50% of the other spouse's PIA. And finally, for the most part, you can get a spousal benefit even if it's greater than the benefits available on your own record. That is, if 50% of your spouse's PIA is higher than your own PIA, there is an exception here, but and it's kind of complicated. So we'll circle back to that in a moment. But first, let's talk about kind of how the benefits are calculated. So spousal benefit, like I said, is 50% of the worker's PIA if she applies for a full retirement age. So we'll use the example here of Jack and Jill. So if Jack's PIA is $2,000 and Jill's PIA is $800, and if Jill applies for Social Security at her full retirement age, her benefit will equal 50% of Jack's PIA, or $1,000. This is a $200 a month more benefit based on compared to her own work record. So what if the lower earning spouse's PIA is more than half of the other spouse's PIA? In that case, she may not be able to receive the spousal benefit. She would be paid her own benefit instead. There is an exception to this, but it doesn't apply to all people, so I'm not going to go into complete details on this. But the basic rule is there are some loopholes, which I'll touch on, if you were born before 1954. So if this involves you, you'll want to reach out to me and we can go over that specific exception. So talk about it here. So here's the exception, and I'll talk, I guess, a little bit more here. Forgot I put it in here. If Jill, in our example, was 62 or older at the end of 2015, she may file a restricted application for his spousal benefit and receive 50% of his PIA while her own benefit builds credits to age 70. Again, I said this a little bit before, but the strategy was closed. It was considered a loophole, and it was closed by the Budget Act of 2015. So this new rule is in place, but anyone who was born 1954 and earlier are grandfathered in under the old rule. So if you're eligible for it, we'll definitely encourage you to take advantage of it. And I'll show you an example here. So regardless of which rule you fall under, the key to maximizing benefits for married couples is to coordinate the two benefits. And so here's what we found. When both spouses have relatively high PIAs, that is, the lower earning spouse's PIA is more than half of the higher earner spouse's PIA, it pays for both spouses to claim the respective benefits at age 70 to get the maximum delayed credit. Our calculators show that if both spouses have average or longer than average life expectancies, this will maximize benefits for both of them over their lifetime. Then, depending on the other spouse's age, one spouse may be able to claim a spousal benefit between age 66 and 70. So here's where this is exception I mentioned earlier. If you were over 62 at the end of 2015, you may be able to claim a spousal benefit at age 66 while your own benefit bills delayed credits to age 70. Please come to talk to us about how we can determine if you're grandfathered in under this rule. So, because if so, it could mean tens of thousands of dollars in extra benefits over your lifetime. Again, if you're born before 1954, this is an exception that you may qualify for. So let's look at an example. Bob and Betty are married. They're both age 59 now. Bob's PIA is $2,800, and Betty's PIA is $1,800. So let's assume life expectancy of 85 for Bob and 95 for Betty. The question we always get asked is, when should they claim Social Security? So I'm going to show you what our calculators show. The calculator identifies several claiming strategies and scenarios for Bob and Betty. In scenario 1, they both claim as soon as possible, which is age 62. In scenario 2, they each claim at full retirement age, which is 67 for both of them. In scenario 3, Betty claims early at 62 and Bob claims later at 70. Scenario 4 is the maximum benefit based on life expectancies of 85 and 95 for Betty. And this scenario calls for each of them to claim at 70. So here's the graph showing the lifetime benefits for each claiming strategy that I just went through. Did you ever think that you could receive over $2 million in Social Security benefits over your lifetime? And that's exactly what can happen if you resist the urge to claim benefits at age 62. You can see here that they will get the most lifetime benefit if they each claim at age 70. In this case, Betty is not entitled to a spousal benefit here because her own benefit is higher than more than 50% of Bob's PIA. But if Bob dies, Betty will be entitled to a survivor benefit. And this chart shows the first year survivor benefit for the longer lived spouse, in this case, Betty. When Bob dies at age 85, she will step into his benefit as her survivor benefit. And you can see here that the two scenarios that call for Bob to claim at age 70 will give Betty the highest survivor benefit. Now, what if we change Betty's PIA to $800? So this is less than half of Bob's PIA. So she should be entitled to what's called a spousal benefit, to up it to so that it's at 50%. And here are the scenarios if Betty's PIA is 800. Again, the calculator is going to show amounts that they would receive if they claim early at 62, at full retirement age, if Betty claims early and Bob claims later, and then the maximum lifetime of them both claiming at age 70. Her benefit is actually a combination of her own benefit and a spousal add-on to give her a total benefit of $1,400, which is half of Bob's PIA. So you can kind of see this right here on the claiming. For Betty claims add-on, it's the additional and added on to Betty's claiming on her own record to get up to that $1,400. So Betty will max out her benefit by claiming at full retirement age. She would not get more anymore by waiting to age 70. The graph looks similar to the first example, but the total amounts are a bit lower because Betty's PIA is lower in this case, in the second scenario. But you can see at a glance which claiming scenario provides the most lifetime benefits. You can also see how close they are. For example, scenario 3, where Betty claimed her benefit at 62, is very close to scenario 4, where she waits 5 more years and claims at full retirement age. So she might want to go ahead and start her benefit at 62. And these are the types of conversations we would have with you when reviewing claiming strategies. The important thing is for the higher earning spouse to claim at 70, because that maximizes the higher benefit for Bob while he's alive and for Betty after he passes. The total benefits will depend on life expectancy assumptions though also. And again, we used age 85 and 95 here, but we can always change and show you the difference between different life expectancies. So basic rule number 3. A divorced person may be able to get spousal benefits based on an ex-spouse's work record. So we have quite a few divorced clients that always have questions on the rules for claiming against their divorced spouse. So the rules for divorcees are similar to the ones for married couples, but there are a few additional restrictions. A person can receive Social Security based on an ex-spouse's work record, provided the marriage lasted at least 10 years, and the divorced person claiming the benefit is currently unmarried. There are 2 key rules. It doesn't matter, these are the 2 key rules, is the 10 years and unmarried. It doesn't matter when the marriage and the divorce took place. If the marriage lasted at least 10 years, even if the divorce occurred a long time ago, a divorced person may be able to claim Social Security based on an ex-spouse's work record. And it's as strange as it may sound, we've had cases where as they were getting divorced, it was only 9 years. And if you can prolong the divorce procedures to get to that 10 years before the marriage settlement agreement and the divorce is finalized, that 10 years comes into play. So knowing the exact date of marriage and divorce is very helpful in determining whether or not you would be able to receive divorce spousal benefits. So the person claiming the benefit must be currently unmarried, like I said. You could have 2 or 3 marriages after the first one, but as long as those other marriages ended and you're currently unmarried, you can claim a divorce spouse benefit. If you have more than one ex-spouse in your past, and if each of those marriages lasted 10 years or more, you get the choice of which spouse's record to claim benefits on. And so the order of the marriages and the divorces does not matter. Other rules that the ex-spouse must be at least age 62. And if the divorce occurred more than 2 years ago, the ex-spouse does not need to have filed for his or her benefits. So there's a few more things to know about divorced spouse benefits. First, more than one ex-spouse can receive benefits on the same worker's record. So if your ex-spouse has remarried a couple of times, all three exes can claim divorced spousal benefits as long as those marriages lasted 10 years. So thinking of Johnny Carson, for example, he was married 4 times. His first marriage to Jody lasted 14 years. His second marriage to Joanne lasted 9 years. Third marriage to Joanna lasted 13 years, and his fourth marriage to Alexis lasted 18 years, and he was still married to her when he passed. So Jody and Joanna could have each claimed divorced spousal benefits on his record because those marriages lasted 10 years. When he died in 1985, both Jody and Joanna can claim divorced spouse survivor benefits, and Alexis could claim a regular survivor benefit because she was still married to him when he passed. His second wife, Joanne, was out of luck because that marriage only lasted 9 years, so she has no rights to his benefits. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or any other ex-spouses. You don't need to know your ex-spouse's whereabouts, only enough identifying information that the Social Security individuals can help you look up his or her record. And you also need to provide documentation showing the dates of the marriage and the divorce. If you're receiving divorced spouse benefits and you remarry, your divorced spouse benefits will stop. However, you may be able to be eligible for spousal benefits based on your new spouse's work record, or you can switch to your own benefit, of course, if you qualify for Social Security. There's a 1 year, you have to be married at least 1 year before you can claim on your spouses. So that covers the divorce. So let's move on to another important rule, basic rule number 4. This one, there were some questions about widows and widowers and survivor benefits. So now we're going to start a little bit less basic, really, rules, but the survivor benefits. And we'll try not to get too lost in the weeds, but survivor planning is essential, and there are a few things you should absolutely know. In order for a surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in that of a case of an accident. To start benefits, the survivor must be at least 60 or 50 if disabled. However, if the widow or widower applies before full retirement age, the benefits will be reduced, as it's reduced for the regular retirement benefits that we talked about earlier. So some of the same principles that go into deciding when to apply for regular retirement benefits also apply to when to apply for survivor benefits. If you remarry before age 60, you will not be able to receive a survivor benefit based on your previous spouse's earnings record unless your remarriage ends. We've seen cases where a survivor is contemplating remarriage in their late 50s. And in those cases, we've talked about having a long engagement in order to not lose those survivor benefits from the first spouse, if it makes sense, and to remarry after age 50, where you'll still be able to get those survivor benefits. It sounds crazy, but there are still some loopholes. Divorced spouse survivor benefits are available if the marriage lasted at least 10 years. As we saw with Johnny Carson, 2 of his ex-wives could claim divorced spousal benefits after his death because those marriages lasted 10 years. And the survivor benefits are worth twice as much as a spousal benefit. So 100% of the worker's PIA instead of 50%. If both spouses are receiving benefits on one spouse and one spouse dies, the other spouse may switch to the higher benefit. So here's a hypothetical example. Let's say Joe and Julie are married. Both are over full retirement age and currently receiving Social Security benefits. Julie's benefit is $2,000 and Joe's benefit is $1,200. If Julie dies, Joe's $1,200 benefit will stop and he will start receiving the $2,000. So one important note about survivor planning is the loss of, is that you will be losing one of those checks, one of the benefits. And most widows and widowers need at least 2/3 of the amount of income that they were receiving as a couple. So it's really important to plan for the loss of one of those spousal Social Security benefits, even though it's often the higher benefit that will be retained. The death of a spouse means a loss of that Social Security check, so a reduced amount of income coming into the household. Also, please note that if Julie had maximized her benefit by filing at age 70, say her benefit was $2,600 at that time, with the addition of the delayed credits, Joe's survivor benefit would be $2,600 instead of $2,000. So that's a huge jump in income by delaying that filing. So without going into too much detail, the main point I really want to get across is the amount of the survivor benefit will depend on two things: the age in which the deceased spouse originally claimed his or her benefit. This determines the original benefit, and the age at which the widow or widower claims the survivor benefit to determine the actual benefit. The widow or widower will receive the highest income if the deceased spouse originally claimed his or her benefit at 70 and the survivor benefit at full retirement age or later. Higher earning spouses who feel young and healthy often don't think about the survivor benefit when they're deciding to claim on their own benefit. But as we saw in the example of Bob and Betty and Mike and Mary, the survivor's income can be significantly lower if the higher earning spouse claims his benefit early. Survivor planning is a very important part of the planning strategies, and especially for married couples. It can really influence the surviving spouse's standard of living later in life based on decisions you make now. It's really a customized process. So again, please let me know if you'd like to go over this in further detail given your situation. What if you've already been widowed? So let's say your spouse died either before or after starting Social Security benefits, or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate your survivor benefit with your own retirement benefit to maximize income and lifetime benefits? And the answer is yes. You can sequence your benefits and to maximize the advantage. And you can start with one benefit and switch to the other one. So the rule here is to always take the higher benefit last. If the surviving benefit is higher, then you start your own retirement benefit that you've qualified for, and you can switch to your survivor benefit at full retirement age. If your retirement benefit is higher, start the survivor benefit as early as 60, and then you can switch to your retirement benefit, which was earning those delayed credits at age 70. And here's an example. So Wanda is 60 years old now and has a PIA of $1,200. Her husband died before claiming Social Security and his PIA was $2,600. So now there are two things Wanda can do. One, she can resist the temptation to start her reduced survivor benefit at 60 and hold out for the maximum by applying for it at age 66. So when she turns age 62, she can start her own reduced retirement benefit and then switch to the survivor benefit when she turns 66. Or she can go ahead and start her survivor benefit now at age 60. This might be natural choice since the survivor benefit is higher and she wants to start income right away. But what you may not realize is that by claiming the survivor benefit now, it will permanently be reduced for the life. at $1,859 versus waiting those few years to get the $2,600. So of course you can see where more lifetime benefit is going to come if she waits. So her lifetime benefits, if she waits just 2 years, there's a big discrepancy between those two numbers. So these claiming strategies, they're not always intuitive. You're not thinking about them at the time, but that's why, you know, we depend on these calculators to show exactly what the benefits would be over a lifetime on different claiming different claiming ages and life expectancies, which will change the scenario. So we've already talked about the disadvantages of claiming, of early claiming in terms of actuarial reductions. So here's one more problem. One might think that early claiming is good because you figure, hey, I'm going to collect it for longer. But if you claim those benefits before full retirement age and you continue to work, your benefits will be withheld. And this is called the earnings test. And I get this question quite a few times of, I want to start my benefits, but someone is usually still working and earning at age 62, and the earnings test will apply. So if you apply before you turn full retirement age and you earn more than $18,240 in 2020, a dollar in benefits will be withheld for every $2 you earn over $18,240. Now, it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. So this means that if some of your benefits are withheld due to earnings test, your new benefit will be higher, as if you started at age 63, 64, 65 instead of age 62. So this can actually be advantageous in the event that you file at 62 and regretted it. So please don't let the annual earnings test discourage you from working, though. We can figure out how it will affect you, but this is, again, another discussion we would want to have before you claim at 62. So the more money you earn, the more money you will have. Social Security doesn't really penalize you for working, but it does do a reduced benefit, and you still will be taxed on those dollars. So once the adjustment is made, you'll end up with a higher benefit for the rest of your life. So it's not a complete penalize, but there is a reduction. But if you want to avoid the earnings test entirely, it's just easier to wait until you're at full retirement age or later to apply for the benefit. So the earnings test applies to every kind of benefit, whether it's a retirement benefit, a spouse or survivor benefit. It may even cause your spouse's benefits to be withheld. So if John and Jane are 62 and Jane is getting a spousal benefit off John's record and John goes back to work, then Jane's spousal benefit will be withheld and will be reduced. And I've had the question of business owners and self-employed. They're getting paid a smaller salary to try to avoid and get around the earnings test. And I can tell you that they have started to look into that a little bit more closely. And so you may be subject to extra scrutiny, raises some red flags, and could cause an audit. So just to be aware for those that are self-employed and pay themselves below that income level to apply for the Social Security at 62. Okay. So basic rule number 6, our last basic rule. Social Security benefits may be subject to income tax. And most people are subject to income tax on their Social Security. But the amount that the tax that you'll pay on your benefits depends on how much other income you have. We won't spend a lot of time here because there isn't much to be done about it. There's not much you can do about it. There's some ways we can try to reduce your provisional income, and I'll talk about in a little bit here. So the table shows the taxation of Social Security benefits based on various income levels. And income in this case means provisional income, which includes AGI, your adjusted gross income, plus 1/2 of your Social Security benefits that you're receiving, plus any tax exempt interest. So if your provisional income is under $32,000 for a married couple, no benefits are subject to tax. However, if provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. If provisional income is over $44,000, then up to 85% of those benefits are subject to tax. The threshold for single individuals is $25,000 and $34,000. In the case of married filing separately and living with their spouse, 85% of Social Security is taxed regardless of the income level. So the important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax depending on how much other income you have. There's a couple ways you can minimize your taxes on Social Security by lowering other income, but sometimes this can be hard to do. So especially if you have investment income, you should be aware that even municipal bond interest, which is usually tax-free, counts as income for purposes of calculating the tax on Social Security. So that's where I was saying on the tax-free income, that also gets added back in. So here are some other things you can do. If you can anticipate your required minimum distributions from your IRA, these can cause your income to be higher, and of course your Social Securities to be higher taxed. You can consider drawing down on your IRAs before 72 when those RMDs kick in. Sometimes you can do it, sometimes you can't. Consider converting traditional IRAs to Roth IRAs, which generates tax-free income. Again, we'd have to talk to your tax advisor to see if this makes sense to do a Roth conversion. You can delay your Social Security in order to reduce the number of years before the benefits are subject to tax. Trying to reduce expenses and pay down debt and adopt a simpler lifestyle. A lot of my clients don't like that idea. They're willing to pay the tax on their Social Security. But you can continue to manage taxes throughout retirement. We don't want to just do it in the first few years, but we try to take a look at it each year to see if there's any tax advantages that we can put into play to try to reduce the tax that you'll pay in your Social Security. All right, so we've covered a lot of ground, and I'm sure you probably still have some questions. We had some questions sent in to us earlier, and I'm going to go through a few of those in a moment, but here are some of the questions, that we can definitely help you with, and would be glad to help you consider each of the questions individually and put together a plan for your personal situation. Social Security is way too important for guesswork. So let us help you protect your nest egg and maximize your income in retirement. I'm going to throw up our wonderful disclosures, but I'm going to go through a couple of questions. And if anyone has some additional questions, again, there's the question box that you can submit a question and I can answer that. Again, if you would prefer to wait and have your questions answered privately, please feel free to contact me and send me a message and I'll be sure to reach out to you. One of the questions that was asked is, how long must the marriage last in order to claim survivor benefits? And we did go over that one. That was 9 months. You have to be married at least 1 year to claim spousal benefits. The other question, can a widow who was remarried claim a survivor benefit from her previous spouse? And again, yes, we went over that. So yes, if, but only if she remarried or he remarried after the age of 60. Other questions? This is one that we didn't really go over. So what is the break-even age if you compare claiming benefits at age 62 versus age 70? Right now, that break-even age is around age 78. So gives you kind of an idea of, hey, if you plan on living past 78, it makes a lot of sense if you're healthy to try to claim later at age 70. If a higher earning spouse has a short life expectancy, when should he claim his benefit? Age 70. I know it seems strange, even if they have a short life expectancy, but remember that in the case of married individuals, that higher earner, the longer you can hold off, that leaves your surviving spouse that higher benefit, the longer you can delay claiming your benefit, the higher earning. A widow who qualifies for survivor benefit and her own benefit, when should she take the higher benefit? First or last? Always last. So we're always gonna want that higher benefit earner to hold off as long as possible on claiming Social Security. And those are the questions that I had submitted. If there are any additional, please let me know. And I thank you so much for joining us. And I hope that I've answered a lot of your questions and have given you a clearer idea of the claiming strategies and the complexities of Social Security. When you go into a Social Security office, I can tell you that they don't understand these strategies completely, and they just know how to help you claim. And so we can walk you through and show you exactly how to do those claims and if there are any loopholes for you. And we're about 45 minutes. I'm a few minutes over the time that I thought we would take. So I apologize for that. But I look forward to having further conversations with each of you. So without any other questions, I want to thank you again, and I will talk to you soon.